I'm Nate Lind, and I help people interested in buying or selling online businesses get the transaction done without the deal falling apart. If you're looking to buy or sell online businesses, then be sure to keep tuning in for more videos like this one. Be sure to subscribe and hit the bell for notifications about new videos and interviews. And introduce yourself in the comments. Are you a buyer or a seller? Enjoy the interview.
Nate, do you want to just kind of introduce yourself, kind of tell everybody a little bit about what you've done and
Yep.
why you're so awesome?
Yeah, absolutely. So I've been an e-commerce entrepreneur myself since 2011. I was selling vitamins and supplements, hair care products, health and beauty products for a long, long time. I built up some technology around that to help support me from a business sense. Back then, there wasn't any analytics around like what it would take to understand how much a customer makes over time if you have them on a subscription. So I built a reporting platform that extracted a bunch of data from my shopping cart, put it in a graphical user interface, gave me a bunch of information and insights. And I exited that in 2016. Got a great payday for it. It was with a strategic partner. I had no idea what the mergers and acquisitions universe looked like when I did this. It was just kind of dumb luck and happened to be in the right place at the right time. Another buyer bought the shopping cart that I was using, and I had already met this this individual, this group of individuals, and then after they acquired this shopping cart, they came and asked me if I would sell my platform as well. And I said, "Well, how much are you going to pay me for this?" Not knowing at all how much it was worth, not knowing how to value it. It was it was a total nightmare, so to speak, from me being educated about it and. But I still did pretty good. I got a really good return on it, especially considering what I invested into it and how much money it was making. So that was it was a cool experience. I really enjoyed that, and that gave me my first taste for what the M&A universe was like. And then fast forward several years, had the opportunity to join Website Closers, which is the biggest brokerage for businesses that are online focused. So whether it be digital agencies, e-com companies, SaaS, tech, anything internet related, we've had our hands in it. We've transacted over 2,000 businesses in the 10 years the company's been in existence. We've got over 12 brokers, and each one brings their own background to it. And I've got a significant background in e-commerce, digital products, physical products, delivering direct to consumers. So that's a bit of my background and how I got to this.
Now, for somebody that's in business, they've got some things going on, and they may want to think about selling way down the road, but right now they're just not ready. What are like some of the first things you would tell them in terms of like getting yourself set up for that or monetizing your assets better in the meantime?
The number one thing is you need to be selling as you're growing the business. Your revenue needs to be increasing. Your profit needs to be increasing. That's when you want to sell. You don't want to sell if you're declining. It's a fire sale. You basically, if you're in e-commerce, you can't even get your inventory usually paid for at the price that you purchased it. That's if you're holding physical products, just as an example. So you want to be growing. If you're growing 20% year over year, that's great. If you're growing 50% year over year, that's even better. If you're growing 100% year over year, that's even better. So this part is the most important part. Sell while you're growing. So just like if you're out there looking to raise some money, you don't want to go to a bank asking for money when you're broke. They won't give it to you. It's the same thing. You don't want to be selling when you're going, when your ship is only just barely stable or going down. The next important part is have like all of your business in one related entity that it's doing all of the transactions, unless you have separate business divisions. And in that case, and I want to answer, or I kind of want to talk about a point that you made about like selling off, assets and other pieces of your business. Unless they're like real assets, like real estate or inventory or customer lists or like that kind of stuff, which you can kind of sell a little bit here and there. It is so much easier if you have a bunch of different transactions going on, or if you have a bunch of business entities that have several different transactions within them or business divisions, to have each of those as a business entity separate than if you were to have them all together. If you have them all together and you want to sell a business division, it's a nightmare to try to like separate those things out. So when it comes to the business entity, domestic business entity, even if you're international, don't get a domestic business entity, because it's worth far more on the open market than an international entity. Make sure your company owns all of the intellectual property related to what kind of business it does. Make sure all the sales revenue, all of the money comes into the business entity's bank account. Keep your personal and non-business related expenses off of that bank account. Don't use it like an ATM or a piggy bank for personal use. Make sure you file all of your tax returns. Make sure your tax returns match your financial statements, and make sure they show profit. A lot of people will take their tax returns and they'll use some creative wizardry and show zero profit. That is okay if done correctly. And what I mean by that is, if you're deducting your travel, if you have like a business owner's car, automotive expenses, stuff that's commonly referred to as add backs. That's okay, because we actually add those back to the profit of the business. So when we sell it, that still counts as profit for the business in the multiple. So that part's okay too. You also want to make sure that you're filing your taxes are done on an accrual basis, and your bookkeeping is done on an accrual basis, especially if you're holding inventory. Because if you're a physical sales business and you're not holding or you're not doing it based on an accrual basis, the buyer can't understand what kind of inventory you have at the beginning of the month, the ending of the month, and they don't see a true representation of what your profit is on a month-to-month basis. A couple other big things that are really important. If you have the ability to have a repeat order rate, so customers buying your product, digital, physical, whatever it is, if it's over 25%, that shows that you've got very sticky customers. Buyers love that. If your monthly recurring revenue, if you've got some subscription-based customers, if that's over 10%, that's really great. The higher, the better. And the more you get into like 50 and plus % of your revenue as a MRR, you can actually get valued a little bit differently than you could if you were just doing one-off sales. Other things that are really important is, if you've got a plan to scale into other countries, other geographies, or other channels. Let's say you're only selling using one marketing channel. Maybe it's Facebook or Instagram or Pinterest or whatever that is. If you've got the ability to start scaling into some other marketing channels, that's great. Or if you're in e-commerce and you're only selling on Amazon, if you can start selling on your own proprietarily owned website, that's great too. Another big one is being able to easily transition your company, having, document your standard operating procedures, KPIs, like the metrics that run your business, have that as like a managerial checklist that you can hand off to the new owner. That's super helpful for them. You'll have to do that through transition anyways. But the other part about selling a business is you're selling not only where it's been, but you're selling a vision for where it's going. So, have an idea for what immediate scaling opportunities are. Again, that kind of goes back to the marketing channels or the geographies that it can expand into. And if you show a willingness to stay on board with the new owners for a period of time, maybe you're only selling 70% of your company or 80% of your company. They love that because it shows that you're willing to put some of the sale, the money from the sale on pause, basically for a period of time while you help them get going as well. And often that 10, 20, 30% can end up being more than the 60, 70, 80% that you sold in the beginning. So that part's really important too. So there's a couple of things that are detractors or risk factors for buyers. This is what they're looking at, and they're looking to punch holes in your business. And when you go to list the business, we're really aggressive at Website Closers. We don't list businesses that are only at like a 3x. We get higher multipliers and higher values for our businesses because we work with good businesses, and we've done all of this pre-work. We've vetted our sellers before we even go to the open market. Whereas if you were to go to like Flippa or like bizbuysell.com, like those, there's a ton of junk on there that people just list stuff and they lie about things or they don't know any better. So we've got a huge list of buyers that trust us because we only bring solid listings to the table. But here's some things that even they're looking for, and they don't. There's never 100% trust that happens as a part of the listing process because the buyers, they have to do their due diligence. They want to make sure they're getting a good deal. They want to get a good business with is least it's what has is least risk for them, because what they're trying to do is they want to step into your shoes where you are now. They want to skip all of the bullshit that you had to deal with getting up to this point, all of the grinding, the late hours, the conference, trade show, late night deals, and all that stuff. They want to get to where you are now, and then they want to see it explode even more than where it is. So here's a couple of things that they're looking for. This is risk for them. If you have a high concentration of customer revenue, so let's say, for instance, you're a distributor and your only customer is this one entity, and they do 100% of your business. That's a big risk factor for them. If your product is for sale only on Amazon, and it's a product that is likely to get ripped off by Amazon or by competitors, that's a risk factor too. And when I say it's a risk factor, it doesn't mean it's a deal breaker. It just means that's something the buyer is going to come to the table, and they're going to want to try to chip away at your value. It's like when you're selling a car. If you've got, a scratch in the bumper, that's not a big deal. They may chip away a little bit of your asking price. But if you were to show up with an engine, that's not, it won't even turn over, that could be a deal breaker for a lot of buyers. We don't have necessarily that many deal breakers, and when we do, I'll call it out. But for right now, these are just bumps in the road. These are scratches on the paint. If you have no redundancy within your employees, now this kind of depends on the size of your business. If you're just an independent operator, you don't have any redundancy because you're the sole entity, you're the sole proprietor, you're the one person doing all the work. But what'll happen is that'll limit your buyers. We see listings that'll happen when it's an owner-operated business, and they won't even get looked at by some buyers because they want a team. They want people that are working in it. But again, this is still only a scratch on the paint. There's a lot of buyers that will buy owner-operator businesses, and then they will step in as the owner-operator. So you have to transition it to them. That's where having a transition plan, having standard operating procedures, and it can be something as simple as recording videos like what Dana and I is doing right now. Just take your day, cut it into videos, record a bunch of it, you doing your busy work, save it all, name it, categorize it, put it in table of contents, and boom, you've got a turnover binder right there. I hardly ever see that happen, and I think it's crazy that more sellers don't do it because it's not very complicated. And that by itself, that's like the flight log of a plane. If you had that, it makes the plane worth so much more. It's actually maybe not quite the same because some planes you can't even sell without the flight log of it. But that's something you can get as an analogy anyways. Another couple of risk factors, if the business is not even 2 years old, a lot of people don't want to buy businesses that are less than 2 years old because the likelihood of its success under 2 years is much less than if it were 2 years old. 5 years old sometimes is a requirement. But again, this is just scratches on the paint. These aren't deal breakers. Another big one, this is almost a deal breaker for me. If there's no accountant involved and there's no bookkeeping involved, my ability to list a business is almost nil when there's not some financials to work with. And they have to be professionally put together because the first thing a buyer looks at is the financials. So it's imagine, going into a club where everyone's all, dressed to the nines and you're like in flip flops, you get torn, shorts on, you stand out like a sore thumb. You immediately get rejected by all the tail in the room. You're not walking out with a gal on your side at all. It's kind of the same way. You have to have your financials done. They have to look good. We've got some great resources for that. Also, your tax returns. Again, if they don't match your financial statements, huge red flags. If you've lost a big customer, if you have lost a big account or a sales channel's gone down, that's a big risk factor. If your net margin's less than 15%, that's a big downer for buyers. If you've got excessive inventory, if you hold inventory, that's a risk factor. And then also excessive debt or liabilities on the balance sheet. Those are some big downers for buyers too. And that's pretty much my checklist. I know it's a lot.
I know that a lot of this stuff that Nate has gone through, like myself included, especially when I was starting out or even a few years ago, you probably aren't in a great position right now to be saleable. And that's totally okay. Nate, for every 10 businesses that exist, how many of them are actually decently saleable right now?
Probably not 9.
Yeah.
Most of them we got to spend some time, and it's usually on the financial side. We almost always have to get someone's financials. We call them recasting them. So essentially, that's where if you're not using QuickBooks or Xero and you don't have them in a professional accounting system, we have to put them in a professional accounting system. So that's one thing you can do right now. If you're not using QuickBooks or Xero and you don't have monthly reconciled financials, so a bookkeeper has to get your bank statements, load it up into QuickBooks, and go through every freaking line item and categorize it. If you're not doing that right now, you absolutely have to start, because we can't sell your business without it.
Absolutely. And for those that are out there that were like me for a number of years, having line by line, everything in a row, that isn't just for protecting you during an audit. Like, that's necessary when you go to sell your business or really go get any serious funding or anything, right? Like it's a big advantage. So that's another thing I would say is, like, if you're out there thinking, like, first of all, I'll be the first to admit this stuff isn't fun. Like, nobody enjoys putting all this together. But if I were to say, hey, you're going to get twice as much when you go to sell if you have all this stuff together, which is probably even more, then would that be worth putting it together? And the choice is obviously yes. So when it comes to putting those SOPs together, I'm not an SOP guy. I hate it. But guess what? I want a good multiple and I want my business to sell, right? Or when it comes to, accountants, I never been more uncomfortable than sitting in a room with an accountant. Like, it's not my, forte. But it's important to get good people on your team. And I'll say this too. I don't know if you have much experience. You're probably way smarter than me, so you figured this out ahead of time. But I learned the hard way there's a huge difference between an accountant and a tax strategist. They are not the same human being. Do you have a little bit of advice for somebody that might be misguided?
Yeah, I've run into this issue myself as well. I didn't realize that my CPA wasn't my tax strategist. My CPA is awesome, but he is not hunting for all of the tax strategies for me. I had the opportunity, just because, being on the speaker network and, being a subject matter expert, I've spoken at a lot of events, and it was at those events that I ran into a tax strategist. I don't know if you or your crew know of the Wealth Factory and Garrett Gunderson.
Sure.
Those guys are, they're awesome. And so I actually signed up for them. I became a customer of theirs because I didn't have a tax strategy for what I was doing. And, that was, super helpful for me. Your CPA, the difference between a CPA and tax strategist is the CPA has to cover their ass, because they're the ones that's signing on your taxes that everything is to their best knowledge true, and they are endorsing it as well. So you have to do that in your tax returns. You're attesting to the truthfulness of your taxes. The CPA is also attesting to the truth of your taxes. A tax strategist can get creative. He can wheel and deal, because he's not attesting on your tax return. So he can offer you some suggestions and some ideas and some strategies that you can research. You can figure out your threshold of the aggressiveness of your tax strategy or the conservativeness of your tax strategy, and then you can employ that. And there's actually some stuff that you can do even before you engage in working with the broker that you need to do for tax strategy too. Because if you just sell your business, just going forward, like, the average Joe, it'll be a capital gains, which is, still not too bad, 20%, tax event. But there's some ways to reduce that if you go to a tax strategist ahead of time. And part of the criteria is you cannot have engaged with the broker. If you're already thinking of selling and you've engaged with the broker, you're limited from using some of these things. Thanks for watching. If you liked this video, be sure to subscribe and tell me what you thought about it in the comments. Your comments encourage me to continue posting videos, and they give me ideas about what to post next. I read and reply to every single one. Also, if you own an online business and you're curious of how much it's worth, click the link below to get a free business valuation with a member of our team. Who knows? It may even be me you're talking to.